Good morning and welcome to the first episode of Wealth for Walls, the monthly podcast dedicated to empowering and safeguarding home buyers and investors in their pursuit of wealth creation through property. So join us as we provide expert tips and strategies in finance, law, and property to assist you in achieving extraordinary success in your property journey. My name is Mohit and I'm the co-founder of my mortgage broking business called Capital for Castles. And today we'll be talking about the latest updates on interest rates and, more importantly, problems with waiting and what sort of legal implications it can have around that. But before that, let me introduce my peers to you. I've got Amir. Amir Sehat is a passionate and independent property advisor who utilizes data-driven system to analyze property market trends and streamline property acquisition. And I've got Melissa. Melissa Barlas is from Conveyed. She's an experienced property lawyer. She's been in the legal industry for almost 10 years now and specializes in all things property and conveyancing. So welcome.
Thank you, Mohit.
Thank you, Mohit. Excited to be here.
Absolutely.
With that, I'll pass it on to you, Amir, if you want to talk something a little bit more about yourself.
Well, as you mentioned, I am a property advisor. I help different type of clients, including home buyers, property investors, and mom and dad developers in the journey of purchasing their ideal property. And we use data in order just to help them with the process.
Fantastic. And Melissa?
Thanks, Mohit. So as you nicely put, I'm a property lawyer by trade. I'm the director of Conveyed, and we specialize in the conveyancing space. So we are a law firm, which means we do a hell of a lot more for clients, and we help all walks of life, people that are buying, selling, transferring between related parties, self-managed super funds, you name it.
And you do it beautifully as well.
Absolutely.
Thank you, gentlemen.
Fantastic. That's great. That's great to hear. So let me just kick this off with a little bit of updates from the interest rate market. As you all would have known, the cash rate went up for the 12th time since May 22 on Tuesday. Surprise. It's gone up to 4.1% now. Some of the major banks have already passed through this cash rate rise to the clients, and we're expecting other ones will follow the suit as well.
Was it expected, Mohit?
Well, look, here's the thing. So there was some mixed views. Some analysts were saying, nah, RBI is going to have to put a pause on this rate rise for this month. But some of the chief economists from the major banks, they were of the same opinion as well. But here we are. The rate rise still happened. And all this happened predominantly to curb the inflation. Inflation has been still rising. Now, this is a little bit interesting, right? So you might have also heard, I think late last week, Fair Work Commission has decided to increase the Australia's national minimum wage by 8.6%. Now, in banking terms, people say the more you earn, the more you spend. So if the minimum wage is going up, I don't know how that's going to impact the inflation and how successful we'll be to control the inflation, but the time and the economy will tell us that picture.
Absolutely.
Do you see any relaxation in the interest rates at some point, and when do you think that would be for the mortgage prisoners like many of us?
Yeah, well, look, the interest rates, people are still thinking that there might be one or two more rate rises over the next 3 to 6 months kind of time, and then hopefully by early next year it should start easing down a little bit. Now, mortgage prisoner is a term that's used when people are rolling off their fixed interest rate at 2% that they secured about 2 years ago, and now they're looking at 2 to 3 folds increase in the interest rates. Because when the interest rates rise, your borrowing capacity drops, which means you can't service the loan. So for customers like in those situations, some of the banks have actually come out with a streamlined refinancing policy. And what it does is that instead of putting a standard 3% buffer on the top of your interest rate to assess your borrowing capacity, they will only put 1% buffer. That makes a lot of difference. Now, there is a lot of eligibility criteria attached to that process. So it's best to get in touch with your bank or with your broker. But yes, we do see light at the end of the tunnel, Melissa.
Good news.
That's
Yeah,
good.
yeah. So let me put this to you, Amir, from a property point of view. We have noticed that some property buyers have chosen to pause their purchase and they want to wait and see what the market does in coming months or year time. Do you reckon it's a sound strategy?
Look, Mohit, in order to answer your question, I'd like to address it from two different angles: the lending perspective and the property market trends. As a simple fact, the more the RBA increases the cash rate, home buyers and property investors will have less and less borrowing capacity. And that means fewer buying options available to property buyers due to their lower budget, okay? At this stage, many people believe that property prices are going down, but this is far from reality. According to CoreLogic, the housing downturns appear to be over, as the home value index has shown consistent growth for 4 consecutive months. Notably, Sydney has seen a substantial increase, with home values rising by about 5% in the past 4 months. Brisbane and Perth are showing monthly growth rates over 1%, while Adelaide and Melbourne are experiencing accelerated growth with gains of 0.8% and 0.6% respectively. You may wonder why property prices are rising despite the RBA's ongoing cash rate increases. Well, it appears that the combination of low supply and high demand has been enough to offset the downside factors of higher rates. Again, according to CoreLogic, the current property inventory levels have seen a significant decrease of 15% compared to last year. So this shortage of available properties has created intense buyer competition and a fear of missing out in the market, resulting in price growth in the end. On the other hand, there has been a significant increase in demand from overseas migrants, as they prefer buying or renting, especially when the rental market is in such a crisis and vacancy rates are at a record low in 50 years. In summary, prices are going up, borrowing capacity are going down, which is a terrible combination for prospective buyers. The longer they wait, the higher the chance of being priced out of their ideal suburbs, as property prices continue to rise while the budget shrinks. So with the additional demand and the stock shortage that we're currently witnessing, data sort of indicates that waiting would result only in purchasing at a higher price. For instance, on a $1 million property in a suburb with an annual capital growth rate of 10%, delaying the purchase by 1 year could mean a price increase of $100,000. And that's a significant amount of money that could have been saved by acting quickly and using a streamlined purchasing process. So considering all these facts, I am not really convinced that waiting is a wise choice. To me, it simply translates to missing out on the significant capital growth that is currently happening in the market. So that is my idea. What are your thoughts on this matter, Melissa?
I completely agree. I mean, at the end of the day, supply and demand dictates the market. If the supply was much higher in terms of properties or stock on the market, if it was much higher, we'd probably see a different, it would be much different in the market in terms of how fast the prices are appreciating. But certainly from a legal perspective, you also need to consider the availability of any grants or stamp duty concessions as well, because they might be available today, but they're not going to be available next year potentially.
Sure.
You just don't know. You don't know, because government regulations around stamp duty and any other concessional discounts when you buy are always changing. So it's, and now, you know, you've got the first home buyer guarantee scheme, which Mohit, you've helped clients with as well. That might not be around forever. You've got first home buyer stamp duty concessions. So, and you've also got concessions if you're wanting to buy within the city of Melbourne or in a capital city zone if there's a new property. So all those sorts of regulations around stamping can always change as time goes on. So you kind of have to take that into account as well, in addition to how the market is tracking. So I think in terms of making the best legal and commercial decision, I agree with your sentiment, Amir. Now is, don't wait for the right time. A lot of people say, I'm waiting for the right time to step into the property market. It doesn't exist. It's a myth. Don't think about the right time. If you just look at it as at a basic level, property is a stable investment. It appreciates over time. You wait, you can potentially get priced out. You just have to take all that into account.
So the message is act now.
Yeah. Exactly.
It's the right time. Yeah. Fantastic. Well, this is it from us today. Thank you for joining us, and we hope you found this episode valuable. If you have any questions or any particular topics you'd like us to consider, please drop us a note, and we'll see you next month on 6th of July after the next RBA meeting. Till then, stay warm and stay safe. Thanks.
Bye.
Bye.